Hi, and welcome to our weekly market update from Morton Brown Family Wealth for the week of April 12th, 2021. I'm Dennis Morton with Cody Demo. Cody, how are you?
Good, how are you?
Great. So we got a busy agenda this morning, but first we want to mention we have our quarterly market update coming up next week, April 22nd at noon. You can follow the link below to sign up for it. We'd love to have you join us. We're going to cover some of the market churn and things that happened in the first quarter, and also talk about planning topics heading into the latter part of 2021. So, Cody, today we're going to talk about earnings. Banks came out with earnings recently, and there's some upside surprises and upside potential for this quarter. We're also going to talk about the government debt and its relationship to inflation. Then we're going to get into retirees' inflation expectations and what is really a big fear for a lot of pre-retirees. And finally, we're going to cover one of our favorite topics, which is stock picking. So it's been top of mind for people as well. Let's kick it off with bank earnings. We had Goldman Sachs, we had JP Morgan. What are they telling us about the first quarter?
Yeah, so JP Morgan, Goldman Sachs, and Wells Fargo all reported earnings today. They all beat expectations, which was really good to see. I thought some of the best news actually came from JP Morgan, how back last year they put a lot of reserves aside, getting ready to cover defaults that they may have on loans. And they released another $5 billion that they had set aside last quarter. So that's great to see that they're not worried about all those defaults anymore.
Yeah, I think sometimes when we go into one crisis, we're immediately thinking, is this like the last crisis? And this is one of those areas that's totally different about the pandemic versus the great financial crisis, is it didn't turn into a financial crisis that, took down banks. And that was, so the loan loss reserves, they're kind of getting pushed off the books, positive development. The year-over-year trade is interesting. We're heading into, everyone's reporting on their first quarter this year. And the market expectations are for earnings to increase year over year by 25%. That's a big number. And it's important to keep in mind, could we hit 30%? That would be an extraordinary recovery. But if we hit 20%, that's actually going to be a disappointment. So we got to bear that in mind, right?
Yeah, that's definitely something to bear in mind, especially with the high valuations that we have currently. So if we're not able to meet those growth expectations, that's where you can see a little sell-off in some of the stocks. But so far, it's looking like we're having some good growth.
Yep, absolutely. All right, so we found an article this week from Liz Ann Saunders at Schwab. And Liz Ann does a great job of putting things in context. And one of her questions recently was, is there a relationship between massive government spending and inflation? Sometimes there's this connection. If the government spends a lot, is it going to drive prices higher? Cody, why don't you start by pulling up this chart that Liz Ann used, which was a dot plot showing by decade the relationship between inflation, which is on our y-axis there, and public debt as a percentage of GDP, which is on your x-axis. So what you see in this chart, on the far left in the light blue, is the 1970s, which many will remember had high inflation, a lot of those years. The 80s is kind of the burgundy color there. But we also had percentage of debt to GDP was in the 30, 40, 50% range. Then as you kind of go out further along that x-axis, you see recently the 2010s and the 2020s, where you have 90, 100, 110% of debt to GDP, and inflation, the needle hasn't moved. I mean, we've been talking for a long time about how policymakers, from a fiscal policy perspective, from Fed policy, they've wanted inflation to rise, to get to 2%. They've wanted wages to rise, but they've been pushing on a string. So, Cody, I think this is a great visual reminder that massive spending and inflation have not been coincidental for the last 50 years, right?
Yeah. I think this is a very interesting chart. Because I know that's what a lot of people were concerned about when we had all this spending. How is inflation going to be? I mean, we're still obviously going to see how it is going forward, and people are expecting inflation to pick up and honestly be a welcomed sign.
So, in her article, Liz Ann also talks about what some of the potential remedies are to kind of rectify the spending versus inflation. What does she talk about? Some of the options that the government's going to have to right size spending.
One of the items she spoke about was keeping interest rates low. And if we're doing that with the higher inflation expectations, we're going to still be in a negative yield, real yield environment, which obviously is not healthy. The couple of the other options she spoke about was lowering government spending, which doesn't really look like that's going to happen anytime soon. And then the other is obviously raising corporate taxes, which is being discussed now. So we'll see how that goes moving forward.
Right. Well, one of the ways that a lot of this debt creation is palatable right now is because the debt service is so low because interest rates are low. But if interest rates start creeping up, that creates some pretty substantial issues. So I think right now it feels manageable because of where rates are.
Yeah.
So speaking of inflation, there was an article in Morningstar recently about how to manage inflation, how retirees can invest to protect themselves against inflation. An interesting stat, a 2019 study of the Society of Actuaries asked pre-retirees and retirees about what their greatest worry was when investing, and almost 2/3 said it was inflation. They're worried about keeping up with the cost of living. That's kind of surprising because, as we said, where has inflation been? It's not something that's a recent risk, right? That's going back years. What did you?
Yeah, exactly. I mean, I thought that was surprising that 66% of the people were cited as putting inflation as one of their top worries, especially because in the past 10 years, inflation was less than 1.5%. I mean, and it's obviously was really low last year with the economy slowing down. But that definitely is interesting, and it should be an important factor moving forward.
Yeah, I think it's something to be aware of, but they break it into three ways that investors can manage that when they invest. So the first was kind of broad hedging, narrow hedging, and then inflation beaters. So the first category of broad hedging, this is what they refer to as using things like inflation protected treasuries, where you can invest in bonds whose prices will go up as inflation goes up. Now, most bonds, we've talked about this before, most bonds pay a fixed rate and their price moves relative to interest rates. But inflation protected treasuries actually increase in price as inflation goes up. So it takes that fixed part of your portfolio and gives it a little bit of a nudge, right? But then there's the more narrow band. This is commodities. Cody, historically people have asked, can I use gold? Can I use, other commodities? There's challenges with doing that. What are some of the challenges that they brought up in Morningstar about using narrow-based hedges?
One of the challenges they spoke about was REITs. And obviously we all saw what happened last year with the pandemic. We had to shut down a lot of the shopping malls. So that brings a huge challenge when you're trying to use that to hedge against inflation. I mean, if you're shutting down the shopping malls and they're not obviously getting the income they're used to, that definitely brings a challenge to that.
Now, in normal times, REITs can have advantages because they can raise rents and they can have some pricing power. So there's a place for them there, but they do tend to be more narrow. The other thing about investing in commodities is that it's not always what we're spending our money on. So if you invest in it's energy or materials or agriculture, but that's part of the basket. That's the food and the energy consumption. But then there's things like healthcare and services and cable bills and gym memberships and all those things, which if you're investing in commodities, that doesn't help you fight against inflation on the service side. Then the last category was inflation beaters. And this is one that's really interesting for us and probably is a little bit neglected when it comes to portfolio construction. One of the best things you can do to beat inflation is to be invested with a 10-year plus horizon, right? That's where we say, equities with long-term rates of return in the high single digits on average, that's one of the best ways, but you have to have a long-term horizon. So one of the greatest risks for inflation is to get too conservative and to remove that long-term stuff. So, I mean, we've talked about that for many years. So, and diversification is working, right?
Yeah.
The last piece we're going to touch on today, stock picking. We pulled up a blog of Dollars in Data, which is a great blog if you haven't checked it out. Cody, another case for why you shouldn't pick individual stocks. What does the author say here?
Yeah, so he wanted to talk about a different avenue compared to the normal of how fund managers normally don't beat their benchmark. And a quick stat on that, over a 5-year period, over 75% of fund managers don't beat their benchmark. So professional money managers and all the analysts they have can't beat the benchmark, why should an individual think they can beat the benchmark? And then he went into a different story, and he was talking about, and I like the analogy he gave of if you're watching a sport event, you can normally tell within the first 5 to 10 minutes if someone has skill or if they have potential. But how can you tell that about stock picking? Is it 1 week return, 1 year return, 5-year return? It's all over the place.
Yeah, you give the analogy of like a basketball coach. Like if a basketball coach watches a player at the free throw line, they might make the first 3 shots out of luck, but by 10 or 20 shots, you know if this person stinks or if they're any good. But it could take 5 years, 10 years before you determine, is somebody lucky? Are they good? Do they have any talent here? And by that time, what are the consequences for you as an investor approaching retirement? If you're 50 years old, 60 years old, by the time you figure out if you're any good at stock picking, 10 years have passed. And that's a lot of time to figure it out. So almost the psychology is to say, can we accept the returns of the market by doing it in a low-cost indexed way and finding the right balance between conservative, aggressive, all those things, and then let it be. And that's the case to be made. How do you know if anybody's any good? It's a great question to ask. It's a thought-provoking question.
Yeah.
So, thanks for joining us today. We look forward to seeing you next week for our quarterly market update. Again, April 22nd at noon. Follow the link, and we'd like to see you there. And if there's anything you'd like to hear us talk about in the future, send us an email. We'll be happy to discuss. Until next week, we'll talk to you soon.